Hello, welcome back. Today is a little bit gloomy outside, and I'm just about to head into work, but I wanted to talk to you guys briefly about real estate investing and why I'm so excited about it as a means to grow and build wealth. So why real estate investing? There's so many different investment tools out there. You could go on Robinhood and buy stocks and equities. You could buy government bonds. You could go and get a money market account with your bank. You could put it in a savings account. You could buy gold. You could do collectibles. You could invest in watches. There's so many different things that you could invest your money in. Why did I settle on real estate? Well, I evaluated all these different investment products based on a few simple criteria. The first being risk. Wherever you put your money, you want your money to be safe. You want to get exposure to upside without a ton of downside, or at least you want your investment to be somewhat risk tolerant. The second one is upside. Of course, the only reason people invest is to make money. And if you have an investment product that is not going to appreciate very much or give you relatively little returns over a long period of time, let's be honest, that's just not very exciting for the majority of us. And although that type of investment has its place amongst the portfolio, for me in my position right now, I want something that has a little bit more oomph to it, that can generate a little bit more returns. And third, you want something that has good liquidity, meaning you can get into this product, you can get out of this product. There's plenty of buyers and sellers and market makers so that you don't have to worry about not being able to exit your investment or getting stuck with it. And along with extra liquidity means you have more stability and less slippage when you sell or buy shares. So to illustrate slippage, if you've ever bought or sold anything that doesn't have a lot of liquidity, you'll notice that you'll actually move the price a lot, right? And that's not what you want. So for instance, if you're buying or selling crypto on Robinhood, Robinhood itself isn't a cryptocurrency exchange. And it seems like what they do is they will match buyers and sellers when they can on the front end, but then they go and they execute their orders on some other exchange. So when you buy or sell crypto on Robinhood, sometimes you're paying a premium, and sometimes because there's not that many buyers or sellers, if you have a large order, you'll actually move the price anywhere from a few decimals of a percent to even 1% or 2% on a very volatile day. So liquidity is definitely something that you want and something that you consider more when you're talking about larger amounts of money that you're investing. So we can eliminate a lot of these more exotic investment types like trading cards or watches or exotic cars or even like cryptocurrency, things that maybe present too much risk, or there's not enough liquidity, or you need too much knowledge in that space, otherwise you're going to get burned. We can eliminate those out of viable candidates, right? Then what about government bonds and corporate bonds and that kind of thing? Well, I think those are still great, but generally those types of fixed income assets don't really generate a whole bunch of upside, right? So you want something with more upside. And the last criteria, if we're talking about building your wealth quickly, is leverage. You want to look at what asset class offers leverage, but you also want to use that leverage and be in an environment where that leverage can be used and deployed in a responsible way where you're not going to blow up your account. We all know that if you add leverage, you're going to see outpaced gains, but you can also see outpaced losses. And so you want to deploy leverage in a semi-asymmetric way so that you can capitalize on that upside without risking all that downside as well. So going back and looking at all these asset classes and collectibles and ways that you can invest your money and applying these criteria, you can see that you can very quickly eliminate a lot of these different asset classes and investment ideas. The first being liquidity, right? You want to buy and sell something that has a big market, an understandable market, a market that doesn't change and has good transparency, that stands the test of time. And a lot of these collectibles, a lot of these fine watches or fine jewelry or these kind of more exotic collectible / investment assets are things where you need to have a network around. You need to have a good dealer, a good seller, a good buyer, and you need to be able to access these buyers and sellers without a lot of overhead, without a lot of fees and commissions. And you also need to know enough about these different assets to pick the right one and to also buy and sell correctly. And that's not easy for these types of asset classes. So what about government bonds? Well, government bonds, again, I mean, they're great, they're stable, but they just don't offer a whole lot of returns. And like I said, it does make sense in a lot of people's portfolios, but for me, generally, I stay away from government bonds. I think if you're gonna look at bonds, picking a good corporate bond is probably gonna give you slightly better yield, and it's gonna give you the potential for more upside, actually. So, I would suggest looking at corporate bonds. But to be honest, bonds as a whole don't interest me that much because the upside is fairly limited. And for me, I don't have so much capital that I can't manage, where bonds make a whole lot of sense to me. So I'm looking more at, equities versus real estate. So why pick real estate versus equities or stocks, right? Well, in both cases, you have access to leverage. In both cases, you can have swings in the market. Some years the S&P or a stock can go up, 10%, 20%. Some stocks like Tesla, 300%. So equities definitely have a lot of upside potential. But as we've seen in the last couple of months, they can also have a lot of downside potential as well. And real estate in a lot of ways has similar upside, although, in most cases not quite as extreme, but can still be extreme. And it has a lot of downside protection. And with real estate, what I really like about it is there's multiple streams of income. So with stocks, generally you have dividend income and you have appreciation. With real estate, there are multiple channels in how you can get value out of your investment. So let's talk quickly about what the benefits of real estate are, how you can make money in it, how you can control your risk, and how I see this bet is actually a semi-asymmetric bet if you buy your real estate correctly and you deploy the correct strategy. So what are some of the ways that you can make money through real estate? The first is through appreciation. Say you bought a house for $100,000. If the house after a few years is now worth $200,000, then you made $100,000 in appreciation. The second way you can make money in real estate is buying a house at a discount below market value. Say you're in an area where houses with a similar square footage, similar numbers of bedrooms and bathrooms are selling for around $400,000. The house you're looking at is owned by, an older couple. They haven't maintained their house very much and it needs a little bit of work. Maybe they're selling it for $300,000. If you buy it for $300,000 and you do some renovations to it, then you can relist that house on the market for $400,000 and pocket the difference. Or if you never sell it, your house after the renovations will be appraised at the new median home value in that area, and you'll have captured that amount of improvement in equity. The third way to make money in real estate is by collecting rent. And rent means that you have positive cash flow. And cash flow is great, not only because it means that you have a few extra dollars every month of profit, but it really enables this whole strategy of buying real estate and investing in it. And it unlocks the potential to leverage your real estate in a safe way. Without cash flow, a lot of the other potential benefits that you can have from real estate don't work. So it's key to this real estate investing strategy. So the fourth way to make money in real estate is through principal paydown. And this goes hand in hand with number 3, cash flow. If you can buy a property that generates more income than expenses mainly including maintenance and also your debt payments, paying off your loan's interest plus the principal every month, then you have a positive cash flow property. And this has a lot of unique benefits. Let's say you bought a $400,000 house and put down a 25% down payment. So you put down $100,000 and you borrowed $300,000 to buy this house. And that means roughly, let's say that your payment to the bank every month is $1,100. That covers your interest payment for that loan and also the required amount of principal that you have to pay back. And then let's say you go and you find a renter and they're gonna pay you $1,100. So on the surface, it looks like you're not making any money because $1,100 comes in from the renter and $1,100 goes out to the bank. But in actuality, every month, you're actually gaining money. How are you gaining money? Well, that $1,100 pays back the interest and also principal. That principal is what builds equity in your home. So let's say of the $1,100, $900 goes towards interest. That means every month $200 goes back towards paying the principal of your loan. That's $200 that gets added to the equity of the house. You own $200 more of your house because you paid back that principal. So even if on a cash flow basis, it looks like you're not making any money that month, you're actually up $200 every month. And what's even more exciting is if you extrapolate this over 30 years, assuming nothing else changes, every month you're paying $1,100 to the bank and you have a renter that's going to pay you $1,100, over 30 years you're going to pay off the entirety of your loan, which means that your $100,000 will have given you full ownership of your $400,000 house, which means that for putting down $100,000, your renter has actually paid $300,000 of principal for your loan, and now you own that house outright. So you've turned $100,000 into $400,000 asset. So that's great. In real estate, you can take out a loan, leverage your money, and over 30 years, you're guaranteed to have that loan paid back as long as your property cash flows. That's already a big advantage over equities and stocks. So what's the big deal about that? We all know that with equities and even Robinhood, you can also leverage your account. You can borrow money and use that money to invest. The difference is what happens when the value of the thing that you're investing in drops. So in stocks and equities and in Robinhood, when you borrow money to buy stocks and equities, if the value of those equities drops below a certain amount, you get what's called a margin call. A margin call is basically a notice from your lending institution that you need to add more funds to secure your debt. If you don't add more funds to secure your debt within a certain amount of time, they will liquidate your account. Meaning for a lot of you, you understand that if you buy a security and it's a good investment, even if it goes down in the short term, over time, it's gonna be making money and you're gonna recover any losses that you have in the short term. Well, with a margin call, if you can't fulfill that margin call, if you can't put in additional capital to cover your liabilities, then your lender is gonna liquidate your entire portfolio and you're never gonna have the ability to hold those shares until they reappreciate or reinflate and you're break even or you're making a profit. So you can actually lose a lot of money by leveraging in the stock market. In real estate, it's a little bit different. It's a little bit different in that you have a loan and it's secured by your asset, but if the value of the asset falls, the bank doesn't necessarily give you a margin call. In fact, it doesn't give you a margin call. As long as you can make your monthly payments uninterrupted, they won't repossess your property. They won't foreclose on your property. So even if your house that was worth $400,000 becomes worth $200,000, nothing is gonna happen to you as long as you can keep making those monthly payments. And that's why if your property cash flows and you're net positive every month, then you can just hold out. You can hold out through these small market gyrations where the value of your property might drop a little bit, but over time it's gonna appreciate. And that's a huge advantage when using leverage. The second thing is the interest rate on a home mortgage is normally much less than the interest rate from your broker when you buy and sell stocks. When you buy and sell stocks, your interest rate is somewhere around 5%, give or take a little bit more, a little bit less. When you're buying and selling real estate in today's market, you're only paying maybe 3.5% to 4%. So there's a big difference in the amount that you're paying for that interest as well. So the last important benefit of real estate are the incredible tax incentives. The first one being depreciation. If you buy a property that has a structure on it, so if you buy a house, that house itself is the structure, you can depreciate that over 27.5 years. And that can be used to offset some of your income from rental property or even other parts of your business. The second one is what's called a 1031 exchange, meaning if you have a portfolio of property and it appreciates, you can take that property and exchange it for another portfolio of equal or greater value and not pay taxes on your capital gains. In stocks, if you buy Microsoft and now you want to invest in Tesla, you have to sell or liquidate your Microsoft shares, pay capital gains on that, and then reinvest what's remaining into Tesla. With housing and property, you can do that 1031 exchange and basically never pay taxes on it until you finally do a cash sale in the future. And if you hold your property long enough to the point where you actually, maybe pass away and hand that property portfolio off to your inheritors, your children, they get what's called a stepped up basis. When you die and they inherit your property, all that property's cost becomes stepped up. And in the eyes of the IRS, there's basically zero capital gains on that property if your heirs were to sell it at that moment. So through depreciation, these 1031 exchanges and the stepped up cost basis when you pass away, it means that there's a possibility where you might never pay tax on your capital gains in real estate. So you can see from all these benefits, real estate is definitely something that you want to look into. It definitely has some unique advantages over other asset classes, including stocks and equities. I hope that helps, and in the future I'll go a little bit more in depth into these benefits and go over some case studies or examples if that interests you. But it's something that I'm super excited in. All right, see you guys, have a great day.